It's 6 a.m., half an hour before the market is going to open on Tuesday, June 12th. Let's take it. Okay, so we got a big reaction in the dollar. So that CPI report must have come out, and well, if the dollar is down, then we're expecting yields to go down. So CPI inflation must have come down. So we'll take a look at that. And this is a huge reaction, though. So might have come down significantly. CPI. Here we go. Month on month down from 0.3 to 0. That's a pretty big move, but we really just care about the year on year and the X food and energy year on year. Month on month is not something that professionals really look at. So X food and energy month on month from 0.3 down to 0.2. And year on year, 3.4 down to 3.3. So some movement downwards, not a huge movement downwards. This one was larger, X food and energy, off of consensus, still lower than consensus, but 0.2% down. So definitely down, but not hugely down. So we've got looks like probably an oversized reaction right here, at least in a dollar market. Let's take a look at our futures. And we're up significantly. S&P 500, more than 80 basis points. Dow Jones also, about 80 basis points. And NASDAQ, almost 1%, pretty close to 1%. So 90 something basis points right there. So this market is definitely reacting to the CPI report. It's obviously reacting very positively. Over here, we see that spike and then maintaining that level sideways. So this is a bigger reaction than I would have expected. But then again, this market was looking for a catalyst. And it looks like we might get some volume in. So what does this mean? We moved up that much on such a small move in the market or in the CPI numbers. I would take it with a grain of salt based on what we were talked about in the aftermarket yesterday. But what will likely happen is this enthusiasm, one of two things. The enthusiasm will persist until we get to the Powell meeting, and then we'll see if it continues through what Powell starts talking. So then we'll get the announcement of whether or not we get a rate cut. So what will not happen is this CPI report will not be figured into that rate cut decision. A report that came out a couple hours before the announcement isn't going to affect that decision. So if they come out and say, hey, we're not going to cut rates, then that could deflate some and we start coming down and then come back down to reality. So I don't expect this to stay up the entire day unless we trade higher into the announcement and then the announcement pulls some steam out of the market. What could also happen is that the institutions take this as an opportunity to take some cards off the table, to take some profits, and then we trade lower throughout the day, which is what we would expect normally, especially on a gap up. We trade towards the previous day close. Doesn't mean we make it all the way down to the previous day close, but we trade towards it. And then we chop around waiting for the announcement. And then maybe once again, the FOMC announcement and what Powell has to say might deflate the market. I could be wrong. He could say something that gets people super excited, but we are in kind of dangerous territory. So this dollar coming down so sharply kind of changes things. The TLT looks like it might gap up as well. But when we looked at the S&P 500, we noticed that this market is being propped up just by a small handful of stocks, mostly NVIDIA, Apple, Microsoft, a couple of others. And there were six out of the 7 FANG stocks were the ones that are propping up this market. We saw that multiple ways. We saw that looking at the RSP. Oops, RSP. There's a delay in my typing for some reason. So RSPs we down here, you can see that the all-time high in the RSP was back in April. And we just haven't been able to move higher ever since then. And we were just at the MA50 right here, actually at a convergence of quite a few moving averages right here. So today's CPI report looks like it's going to help it go up, at least at the open, but we're really not out of this range, are we? If we trade higher, then we will be. But again, I don't expect it to stay at this level, or if we do stay at this level, it's because we traded higher and then we cut back down. So when we look at this multiple ways, when we look at the equal weighted, when we looked at the momentum, right, with so many sectors and the overall indices with fewer than half their stocks above the 50-day moving average, that is not a healthy bull market, meaning that it might go higher for a little bit, but there has to be some sort of pullback somewhat soon. So based on just the CPI report, I wouldn't get too excited. If the Fed actually does cut rates, then we have a fundamental change in the market, and that would definitely change things, and the market could definitely keep going higher if that's the case. But really, we're not expecting that to happen. There's no reason, and Powell has painted himself in a corner, maybe purposefully, in saying that, hey, I'm not going to change anything unless the data shows it and the data reflects it. That's sort of his way of protecting himself politically and saying, hey, I already announced to the world multiple times and insisted that I'm not going to just cut rates just to cut rates. So it doesn't matter what kind of political pressure I'm under. I've already publicly said it so clearly that if I go back on my word, then everyone knows what's happening. So that's his way of protecting himself politically. And I think it's probably a good idea for him to do that in this particular election cycle. So the data just doesn't, even with the CPI report, the data doesn't reflect that he should cut rates. Why? Because a single data point doesn't change anything. We need multiple data points in order to change a picture. And this actually, 0.1% from 3.4 down to 3.3, that's not lowering inflation. It did come down a tiny bit, but that's not a consistent. I wish there was a chart. Is this that's the relative performance index. I wish there was, let's see, CPI report history. There we go. It's this. Okay. So this is not the exact same because it's not this is points, not percentages, but you can see that CPI has been going up, and then just because it came down 0.1%, that does not mean that inflation came down. It just means that it didn't go up this time. It doesn't mean that inflation is down and that we're down at 2%. You see that? So we still have a long way to go in order to hit a 2% target. So we wouldn't want to get too excited just because one CPI report shows that we came down just a tiny bit. So the overall trend is that the inflation is still moving upwards. And if we get 2 or 3 more data points showing lower, 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 then that might represent a change of trend. Just like when we look at these stocks, we say that, okay, this action right here didn't represent a change of trend, But this action over here does represent a change of trend. I needed many more data points in order for me to say that that was a change of trend. So just one report isn't going to do it. So that this reaction that we're seeing is overdone. Say 530, where did we close? About 536, 537 to 541, almost 542 divided by 537. Almost 1% up so far. Yeah, it looks like those S&P futures are still popping. Yeah, almost 1%, about 90 basis points. So there, I don't expect this to stay up here. This is a little bit over enthusiasm. Does the enthusiasm wear off in a single day? Maybe not. Irrationality can stay in the market, actually persist for quite some time. There's the old saying that the market can stay irrational longer than you can stay solvent. So this could last and move, but if we go from a pure analytical standpoint, it should come down. It just is a matter of how quickly this resolves itself. If we see volume, a huge amount of volume come in because of this, then we're probably going higher. But if we see institutions holding off and waiting for the FOMC, which would make sense. That's what a properly risk managed portfolio would be doing, or a portfolio manager would be doing, is I got the CPI, but I still have the actual rate announcement, and I'm going to wait until I see what Powell says. So most likely what we're going to see is movement and enthusiasm, but not a huge amount of volume backing it up, which would give a signal that that's the retail guys doing it. And then as we get the announcement and Powell speaks, that's when you'll see institutions or actually algorithms starting to play around, and you'll get some volume there because algorithms do get a lot of volume behind them. And then towards the end of the day, that's where the human fund managers are going to come in and start positioning themselves. So that's just based on my experience as a fund manager. That's what I would be doing. That's what all of my colleagues would be doing. And so that's really what I expect for today. So don't get too excited in the first few hours of the day. I wouldn't really be making any decisions or moves until after that FOMC announcement. And of course, I wouldn't be trading through the volatility immediately after the announcement and when Powell speaks. So we're just looking at possibly the last hour of the market, and really probably just sitting and waiting and seeing how everything plays out today before positioning myself and making changes for tomorrow morning. So this initially is a sign that we might break out to the positive side, to the bullish side of this box. I mean, it's pretty clear that we're going to open quite a bit above it. Do we stay there over the course of 1 week? That is a question mark for me. We'll probably stay there for the day, but 2 days, 3 days, 4 days, 5 days. I'm not completely convinced based on everything that I'm seeing in the market. But of course, when we're talking about these momentum levels that we're showing, like the RSP, the difference in the RSP, if we look at the stock factor, we still don't have a whole lot of 90-day highs or lows from yesterday. And if we look at the 90-day highs, a lot of them are ETFs, so they don't really count. I should exclude ETFs in this. But we are basically it's like the social media version where everything is pretty and everything is selected to show you the best life that everyone is living. And then there's the actual life that they're living. And the S&P 500, the SPY, is showing you that social media version. and the RSP is showing us the actual life version, and it's not so great compared to what's being played up in the social media. So I'd be careful. I'd be careful right now. Still, I don't. If we are still moving upwards and making new highs a week later, then I'm going to change my viewpoint. But for now, I'm going to be very, very careful. So, and my recommendation is just let this day pass by. Unless you're actively day trading, just let this day pass by before you decide to make any changes in your portfolio. So we'll just see how this market trades throughout the day, and then especially what happens after that FOMC announcement. That is going to overshadow the CPI report, because CPI report is future. It's the next FOMC announcement in July, or more realistically, more like September, not July, because the one data point isn't enough for us to make a change of trend by July. The FOMC announcement is right now, right this second in the market. So the market will react more strongly to that than it will to the CPI. So we'll see how everything unfolds. Have a wonderful rest of your day, and I will see you in the aftermarket.